This is the second book club edition. I think there'll be 4 or 5 of these things when we get done with this by the end of the month. The homework that you guys should have done was read up to page 100 or so, up to chapter 11 of this book, Tax-Free Wealth, written by Tom Wright. This is the second edition. So there were some changes in early 2018 April that went into effect. So that was kind of why there was a second edition. So before we get started, once again, the golden rule here, as I'm displaying on the screen, is no, don't be an idiot or greedy when using any of the knowledge discussed here in this next recording, or if you guys were talking about it. It's just one book and one opinion. I personally take a lot of inputs from a lot of different places. In other words, don't come crying to me if you get audited and somebody else says you can't do it. This is all for Friday night entertainment. It's infotainment. So I'm scrolling down our shared note sheet here that a lot of you guys have been adding stuff into, and I've been updating my notes into, and you guys can feel free to add notes as we're talking here. In this document, we have the master list. What do you guys deduct in there? Feel free to add more things in there. Tips for documenting your tax deductions. I stuck in, in the last webinar we talked about this active and passive mature participation. This is different from the old, are you a real estate professional topic. So I suggest you take a read through that. Here are the notes from the last session from December 28th. And here we are into present day. Any overall question, comments on where we are so far? A couple of people want to say a couple of things. All right, well, moving on. So the first note I have here is use the S Corp to avoid self-employment tax. Highlighting it here in number 1. Any questions or comments about that? I know a lot of house flippers do this. Me, I'm not really using this strategy quite yet, but eventually I will. But I think it stems from on page 90, or not page 90, but page, I don't know what page, but here I mentioned bullet point number 7, the corporate tax rate is currently at 21. So you got to kind of think to yourself, if your personal tax bracket is higher than that, obviously it's good to put some income into the corporate tax.
Hey, Elaine, I think I can speak to that. So an S Corp does not have that corporate taxation usually. So I think what the difference is really your entire S Corp income is going to be taxed, but you're going to get allocated a portion of it to salary and the rest goes to distributions back to you, okay? And those distributions are not subject to FICA and Medicare, unlike the salary. So that's really what the play is on saving on that 15.3% or whatever it is on the FICA and Medicare.
Right, and kind of the why behind that is if you look at bullet point 7 here, I'm highlighting it on the screen. There's 5 different types of income here. The first is ordinary or earned income, which is a lot of our W-2 salaries here. I think what you're kind of saying there, Chris, is when you've got a business that's creating ordinary income, or correct me if I'm wrong here, but the ordinary income, the good thing about that is that there's no employment tax, right?
Correct.
So the idea is, as an S Corp, you carve off some of your profits or your cash flow or whatever you want to call it in.
Yeah, it might even fall under C, and I'm not a tax expert. I don't know if it could be dangerous, but it's probably B or C. But it's not subject to FICA and Medicare. That's the key. Right.
Yeah. And you take one as a salary, and I'm guessing that's B, right? Ordinary income.
Yeah, it's like
the salary is going to be the A. That would be your W-2 income.
Well, I mean, like you were saying with flippers and wholesalers, Normally, like if you have a house and you flipping it and you bringing in labor to like do the painting, the floors, the roof, whatever, you'll bill them and basically 1099 them so you can write it directly off. So it makes it where, you know, the profit you have, you're taking it off so you don't have to count it against you. And that's why a lot of
Well, yeah, but then there's the profit that after you've paid everyone else,
yeah,
then basically you're expected to pay yourself a reasonable salary from the business. And then what's left is distributable income. You can either retain it in the business or you can distribute it back to you through dividends.
Right. And then so salary is B and dividends is C, investment income, which you sort of pay yourself for being.
Yeah, so the part that's not salary is that's where you're going to get the tax savings.
Right. And I've heard, and this is kind of where things get a really gray area, is that there's sort of like an optimal place of, you know, if you have this many, you make this much income, you can take this much salary or dividend split. There's like a game you can play, and the whole thing is don't get greedy, taking too many dividends as opposed to ordinary income.
Yeah.
And I think that's all I want to leave that, unless someone wants to put their own what they do.
Yeah, like I know a lady that has a trucking company, and it's the same thing. She started off as an LLC, but because she started hiring drivers, she switched to S Corp because it made it easier for her to write out their salaries instead of doing it with the LLC. Because then they started treating her like, you know, she had to go and do all of Medicaid tax instead of saying they were independent, so that she can write them off with 1099s easier. So she switched to S Corp to make that easier, so she can use that, like you said, that 7B to take the income directly off without it affecting her income that she was keeping on the back end. So
right.
So what you're just saying right there, are we not mixing up terms slightly? Because I thought the LLC was just kind of like to document it, but then your LLC could be an S Corp, a C Corp.
The LLC is really a legal instrument to shield liability more than a tax feature, because as an LLC can elect to be taxed as an S Corp, a partnership, or a C Corp, and probably others too, but those are the three big ones.
Yeah. Yeah, right. I guess like I said, it is mixing terms a little bit. The LLC she was using to keep from getting sued if the truck driver hit somebody, but then she switched it internally to S Corp because of the employment tax. Yeah, so
yeah, that's for IRS, the election, but the LLC is the legal section.
Right. And is it true to say that I can have an LLC taxed as an LLC, S Corp, or C Corp, and I can have a S Corp or C Corp taxed as an LLC, S Corp, C Corp? Is that true?
Say it again.
I can have an LLC taxes all three of them. I can choose.
Or one of the three.
Yeah. And I can also have a C Corp or S Corp or whatever, taxes LLC, S Corp, C Corp. I can make that.
No, an S Corp is taxed as an S Corp. The C Corp is taxed as a C Corp.
Okay. So I think that's where I originally got confused, and that kind of goes to Reed's question there.
Yeah.
The LLC can be elected to be taxed as either of the three.
Right.
Okay. Right. That's the most flexible structure. And I actually have a series LLC. So I have one of my series that's elected to be taxed as a C Corp, and one has been elected to be taxed as an S Corp for different purposes. And that's kind of a holdover from my days that I was more actively participating in single family stuff, doing the wholesaling flips and all that. So, you know, one was a marketing arm, and we could move things around between the two based on what was most optimal. But since then, I've greatly simplified my financial life, so I'm not really doing anything in those. You know, the bulk of my income is coming from either real estate sales, my brokerage, which I have to be paid individually, or my various apartment complexes, which those are all, I get K1s as an LLC, LLCs that elect to be taxed as a partnership.
All right, so moving on, bullet point 3 here, a corporation to provide service else. Okay, I think we
Kind of went through
kind of
it.
talked through that. Someone else put this question of 2 clients in real estate that leverage their experience to receive government tax credits. I don't know who wrote that one down, if they're on. So moving on, so bullet point 5 here, on page 67, if you guys want to flip to that page, there was a list of high-level examples of what you can deduct as a regular person and as an entrepreneur, right side of the cash flow quadrant. Make a note of it now to, you know, take a look at that master list we have up here. And if you got any more ideas or you want to add anything, you feel free to add more items there. Again, don't be greedy, but if it's necessary for business, let's write it off.
Yeah, and if you haven't filed that way before, you can also, especially if you're going to do it part of your personal tax, you can go download like an IRS form, the Schedule C, and it also has like a list of all the things you can, it itemizes it to help you remember as well to put it on to try to write off as well.
That's Schedule C or Schedule E?
The C. It just it's almost like when you're doing like a sole proprietor, even though you can kind of still use that same stuff if you're doing your LLC as well. Yeah, the one on the top right there. It just says like the name of the company, how you're doing your income, and then it starts listing all the expenses you can write off in the middle, like the supplies, the taxes, travel, you know, all that good stuff. It just kind of helps you jog your mind.
Yeah, and this is exactly how I arrange my like tax bookkeeping spreadsheet. On the top, I've got it in all these columns, so I just hand this to my tax guy.
Yeah, it makes it a lot easier.
Yeah, instead of doing it the other way, where you're kind of going all the travel and then all the expenses that way. This way, like it's going directly into these fields, and you just plug and play.
Yeah,
I'm not as sophisticated as you guys because I don't have an LLC or anything. I'm not doing any of this stuff yet, but I'm kind of probably beyond the scope of some of this, but I'm just kind of curious.
No, it's like say for that Schedule C, let's say you have like a internet marketing business and you're working from home and you want to write off a piece of your room, you know, a piece of your house, and you know, you trade buying and selling stuff on Amazon or eBay. If you're not making enough money to actually go and do an LLC, you can just do the Schedule C as part of your regular taxes to get a piece of that write-off that goes against your W-2 income.
So like I'm going to this Grant Cardone 10X conference. So do I could probably take the cost of that plus the cost of the hotel plus the cost of the meal.
Just throw it into a Schedule C, and just, you know, at the top, I think it says what was your business. So you can say like, you know, whatever your last name is, real estate services or something like that, and then group it as like you're trying to learn real estate, and you can write all that stuff off.
So I mean, I'm not. I don't know. I'll ask somebody else too, but I don't have like any official business anybody. But I can just put it as myself because I'm so at least for like 2019 taxes, I can just, if I don't start an LLC, I could say sole proprietor.
Yeah, it's almost like, you don't mean to make it official. If you didn't go LLC, you can go do like a DBA. Just go get a little DBA with your name as the company, and then do it that way. But you can still, you know, like people who cut grass and things like that make side money, you do it this way as well. So you don't have to have an actual LLC or even a DBA, but as long as you can show that you were separating the money like we talked about last week, that you were showing that you were doing it separate and using it specifically for this business. And it wouldn't give you a lot of write-offs, but it is giving you some credit for you going to Grant Cardone and, you know, the airfare and the hotel and all that.
So some of these fees I already paid in 2018, like the flight and the Airbnb. So I could actually deduct that from 2018 then too, right?
We have, unless you filed it already, but you really can't. But yeah, just put it on for the year 2018.
Because it really depends if you do your books on a cash basis or accrual basis. If you're, you know, an individual, you're going to do it cash, but for business, you can elect to do accrual or not. But I like cash basis because, you know, the end of the year, I was busy prepaying some expenses right off.
Yeah. And
So
you just
cash-
click the little box right there, number F, like he's talking about.
What's that?
And you just check that, and then boom.
Yes, you would. Yes.
So I will say one thing, Reed, is if you went to the 10X conference and you didn't do jack, you didn't make any money, you can't write it off, right? Like if you went and flew to Birmingham and you don't have any Birmingham rentals, sorry, you can't write any of that off because you haven't made any money, right?
Well, I thought it would be
It's like
written off because I'm doing stuff for. I know I just think I was BSing him. I thought since it's like it's business related, since you're trying to develop yourself or something.
Well, so like this is where it's hard, right? Like, and I'm not the one who's gonna tell you if you can do it or not, but if you're a passive investor, I don't know if a 10X conference is deductible, to be honest.
Okay.
I don't know.
Yeah, it's probably it's really kind of on the fine line for sure.
Yeah, it's cutting it close, but you're still getting the income from the K1, so you do have income to offset it to show that, hey, I'm trying to learn more to cross over, you know. Like I say, talk to your tax consultant and your attorney.
I'm not really talking to you, Reed, personally, because I know you got some stuff, right?
Yeah, just in general.
I'm talking to the person who's watching this later on and doesn't have anything owned yet, and they're thinking that they can go and write some stuff off. It's like, no, unless you can look a person in the face and legitimately like show the linkage between that expense and how it made money, you can't do it.
I'll tell you, I don't know how much this really applies to today's situation, but I'll tell you, my dad used to have some horses. He had like 4 horses on 3.5 acres. So he turned our whole residence property into like a horse business, sort of, okay? But it never made any money. It wasn't really intended. He just wanted to write off a bunch of stuff. But I think after 4 years of losses or something like that, it's got to show an income in year 5, or it was deemed to be a hobby. And I think you would have to unwind all those losses in the past.
Right.
So
this goes back to the
change, but there are certain limits. You know, at some point you got to start earning income to offset those expenses.
Yes. Or you
Yeah, I think I'm kind of in the same similar boat as Reed, right? It's just deciding if I actually need to form an LLC at this point to get some of these deductions. It sounds like maybe you don't. Definitely can't do an S Corp if you're not making enough income to cover a reasonable salary, right? But yeah, I mean, I've talked to a few people, and it sounds to me like you could even form an LLC as a sole proprietorship,
right.
And then with the intent that you are taking these educational classes, it is for your business. Right. But your business isn't making money yet. So yeah, maybe it just takes a little bit of time. But yeah, I'm in the same place.
One already.
Now, and I guess a lot of it, just talk to tax professional, but I mean, I know some of the stuff may matter whether it's active or passive, but as far as whether you're at least dealing with other stuff, like whether it's qualified as a business or not, I don't think it matters whether it makes money, as long as you, and maybe this is a gray area, but they say as long as you intend to make money.
Yeah,
so
you can show you're actively trying, yeah.
Mm-hmm.
Yeah, I don't know if you ever have to make money. I mean, maybe you still can't deduct it if you can only deduct it against the money you're making versus active or passive, stuff like that. But as far as like, I don't think it can disqualify just because you're not making money if those deductions can somehow deduct something else, notwithstanding other stuff.
I think like Lane's saying, if you're just going just to the conference to go to see Grant Cardone, and then for the rest of the year, you don't do anything and don't buy any properties or invest, yeah, they're gonna like look at you funny. But like you say, if it's at the beginning of the year in February, March, and then by the end of the year, you bought some property, you could, it's actually showing, like you're saying, you're looking at properties, you're going to different places, and you end up buying something or doing something that's in their business. It kind of works out. So you can't just do that and then try to put it on there. Yeah, they'll hammer you. It'll trigger a audit pretty much. Not the first year, but if you do a year after year, they will.
Yeah.
Usually, yeah.
And I'll say, Greg, I mean, this might be a bold statement, but like an LLC has nothing to do with taxes. Sorry, dog. It's my guard dog. Actually can write off his food if I'd like. But
Right, an LLC is not for taxes, but it can lend some credibility to the official nature of your business, I think.
I think books and speeches, they put a little bit too much emphasis on that.
Yeah.
I just always put myself in the mindset of I'm gonna be like sitting across the table from an IRS agent. Again, I'm never gonna be the person, but like, can you legitimize that expense? Like, who cares if you have LLC or not?
Yeah. I can give you an example because my family got audited before. So like we have all of our properties and everything. My father was a golf professional. He never made it into the money. You know, like you might have 200 people go and play, but top 20 people make it on TV and, you know, like with Tiger and all that. So he was writing that off for almost 15 years before they audited us. And we kept good records and everything, got audited, went in. And the funny thing about it is because everything was in order and he legitimately showed, hey, I'm playing, I'm just not making the cut to get on TV and get into the money, but I have all these expenses. You know, I am a professional because he, you know, he had the golf, you know, the PGA card and everything. By the end of it, they were trying to get my dad to give him lessons because we had everything in order. It was funny, like, hey, he said, yeah, just come out to Gus Wortham Golf Course. I'm out here every Saturday. You just come out and I'll show you some stuff, you know, no problem. So you can, as long as you show that you're legitimately doing it and you have all your books in order and your paperwork, the hotels, the travel. I mean, he was traveling all over the world with it, but he just never really made it into the money because he had his other business and he wasn't doing it full time. So you can survive an audit like we talked about last week. If everything is in order and you can legitimately show, you'll be okay. But like I said, you just don't want to get audited. Like my mother was freaking out, but my dad was laughing about it because he knew it was legitimate. So.
Okay, so I think I kind of understand. So pretty much I can bring it to the accountant, and then like, for example, if I wanted to try and do better, I could say, like say I was going to that Grant Cardone and then I wanted to drive 3 hours and see the Grove. That day that I spent looking at the Grove, I could probably more justify that as legitimate because I could say I at least spent 4 hours looking at real estate to buy,
Yeah,
as opposed to the Grant.
Yeah, he said that in the book. As long as you spend more than 4.5 hours of an 8-hour day, then you're,
I've heard some different things with that rule. You know, the 4-hour thing. I don't know. I mean, it's kind of all over the place. So here's my question to the group. So say I come to Hawaii, I fly out on a Friday, hang out with Lane for 4 hours on Friday evening, and I spend the weekend, and I hang out, I go to a RIA meeting on Monday for 4 hours at least, and look at some properties. Can I write off all the flight? Can I write off Friday, Saturday, Sunday, Monday night's hotel?
Mm-hmm. Because you can show, I would try to do it because I would say, hey, look at this guy. He has, you know, crowdfund, you know, Aloha. He has simple passive.
What about the weekend? What I'm saying is like the weekend, right? And then let's just say you say it to Wednesday now.
Yeah, because I'm talking to you about trying to build my business to, you know,
but we didn't
show that you're trying to build your business.
But we didn't do anything. How do you justify the Saturday, Sunday, Tuesday, Wednesday evening hotel and meals?
Well, he talked about earlier in the book about stuff having a business discussion.
Yeah.
Discuss business. So at least I don't. It's just.
But we didn't meet those days. You were just off.
So later, I think the key is that you want to sandwich your business activities at the beginning and the end of your trip.
Right.
You can have some leisure time in the middle that still qualifies to write off, but make sure you know, beginning and end, that justifies the length of your stay. Now, obviously, it has limits. You know, it could be over a week or so. If you're staying for a whole month and just have something at the end, and it would be cheaper for you to fly back and then fly out again for another trip, then that would, I think, disqualify that. But, you know, as long as it's, you know, a few days here and there and you're bookmarking it with business, you should be good.
Yeah. I mean, so here's how I would do something like that. If I was staying for like a week, 10 days, I would write off all the flight, but then I would really like I would take a lot of the meals out on the days I was screwing off doing my own thing, and some of the hotel nights. That's just how I would do it.
I wouldn't.
This is gonna kind of sound sad, but it seems like what I've kind of gotten the impression with the book, and maybe other people take it differently, but it seems like it's like you got to know what you can get away with. Is kind of almost like what he's saying, and it's kind of, maybe it's good or bad, but it's like, it seems like it's an intuitive thing that some of these accountants have. They know they can. I don't know. That's kind of what it. I guess.
I think what he's doing is he's trying to get you to use his service. So he's telling you good stuff, and then he puts you at a point where it's like, can I do it? So go call up, go to his website and input your stuff so you use him, because he knows everything. He's just telling us a little bit of the icing part. So to make you go use his services, he's trying to, like you say, put you at that point in the middle to make you go, can I do that? Like what we're discussing now. Can you write the whole flight off, or can you, write all the hotels off? If you use him, he'll say, oh yeah, you can do it, or no, you can't, you can only do this. So it just seems like a soft sell. It's pretty cool, but he's still giving you good information. That's what I'm getting from it.
Yeah. I don't know. So Chris, what do you think of my example? You'd write the whole thing off. You wouldn't. You try to sandwich it, but you'd.
No, as long as it's reasonable, you're talking about having a few days in between, especially going back to Hawaii, it would be prohibitively expensive to finish your first business meeting, fly back, then a couple of days later, fly back to the mainlands and do that. So you especially have a really clear-cut case because of your distance that you are from your main business.
Yeah, I like your sandwich idea. I mean,
Yeah, I can tell you one thing. Do all you know who Brad Sumrock is?
Yeah.
Okay, so Brad, my sister-in-law's in this program. I know Brad, but not as well as she does. But I went to his he had an apartment conference last year here in the Dallas area, and he was talking about the tax advantages of moving to Florida. He already lived in Texas. And so I was chatting with my sister-in-law, like, what's the difference tax-wise? I mean, they're both no tax states. Okay, so he was making it sound like it was a big deal to move to Florida. And the reason why he did that is because all his business is headquartered here in Dallas. His personal residence that he claims is in Florida. So every time he has to come here for anything, it's all a write-off. And he has an apartment here. I think these cars here and all this. It's all business expense now.
Yeah.
For all the time he spends in Texas.
But again, because of his scale, he can show when he's in Dallas, he's strictly doing business, even though,
Well, he's not strictly doing business, but it's enough to write it off. Yeah. Yes.
Like
I think what Troy is trying to say, it's like, well, for lowly owed one guy with one or few rental properties, that's gonna be
right. Yes. Obviously, he has the benefit of scale that affords him the ability to do that. But I thought it was a pretty smart tax strategy because he's living out on the beach in Florida and then writing off everything, all his legacy costs here in Texas.
So I got a similar one that the common guy can probably do. You've got I think I mentioned this in the last one, but you've got a home office in your home. You can deduct. Everybody knows you can deduct the square footage, yada yada yada, which equates to like nothing at the end of the day. But the whole point is you're putting that flag into the ground that this is a place of business for you. So if you play your cards right and you're like a contractor, every time you leave your house, your place of business, you're on the road.
Yep.
So now you open up this opportunity to deduct a lot of mileage. So it's kind of the same thing, right?
I don't know if you have to do that because I don't deduct my home office for other reasons, but still it is where I plant my flag. This is, my place of business. So anytime I go to any kind of appointment or any kind of meeting, it's all business mileage, regardless.
Right. And for guys who don't know, Chris is an agent there in Texas, but there's a lot of guys that just call themselves agents or just barely sell one house so they can have that wide reach.
Right.
Here's one. Are any of y'all W-2 employees that also have like a side hustle doing anything in real estate? So what I got from a agent is, put some signs on your car or wrap it, whatever. So go drive around for advertising, and then right before you get to your work, take them off. Okay, so up to maybe your last quarter and half mile of your commute could be marketing costs, driving around for advertising your business. And then you've minimized your actual commuting mileage, which is non-deductible.
So here's my question, like for a guy who's making $10,000 of profit in his rental, at what point does that become too greedy, do you think?
As long as you can show and zero it out, like I say, if you can document and show, like he's saying, that, hey, I'm driving around trying to find other properties and I'm legitimately trying to grow my business, you can write all that stuff off.
Yeah.
Yeah, I'm not sure.
They're not gonna look at you until like the third or fourth year. Like if you write all the same stuff off and by the second, third year you haven't done anything, then it's gonna trigger. But it wouldn't trigger like the first or second.
But if you live in California and you're buying properties in Dallas, it's going to be hard to, unless you're looking for investors or distressed. I don't know. I mean, that's another thought.
Oh, I have a lot of California investors buying properties here because the market's much better for it. But typically, they're not spending a lot of money on business expenses. Usually, we're doing everything remotely.
Right. Then that's what I'm saying. It's going to be hard to justify driving around your little car in California when you're buying properties across the country.
Right.
Well, I mean, so as long as you can explain it. Like I would say, hey, I was trying to find stuff in California, but like here, the price is too high. So I'm looking around trying to find a good nugget. But in the meantime, I've been buying stuff in Dallas because, I go to this Grass Sunrise group. So I was buying stuff there because it was like half price, super discounted, but I'm still looking in California trying to find that deal because I know there's some here. And if you can explain that and you have your documentation, I think you'll be okay.
So I personally would disagree. If you're buying properties in Birmingham and you're driving around California, until you buy that property in California that makes $1, you can't deduct a single dollar. Well, that's my feeling.
Well, I mean, it's kind of like going to school and you do the deduction for your Hope credit and your lifetime credit. You're going to school and you're not getting the income from it, but you can still write it off before you actually go get that job. So you can write off the 4 years of college before you actually start working. If you can show the progression that, hey, I did the 4 years of college and the next 2 years, I started my business. I got a job as a, like say for you, an engineer, but you still got to write off the 4 years up front, like especially if you're on your parents' return or something. So it's kind of the same thing. As long as within a certain time frame, you actually, to me, starting in you can show that you have the progress to try to buy something, then I think you could be okay. Because to me, like, it was scary because when you're sitting in front of them, they're auditing you and they're asking you these questions. But if you can explain it and you have documentation to show it, it completely changes the conversation quickly. If you get there and go, well, they'll tear you up. But
yeah, the other thing I think you have to be careful of, and again, I'm not the authority on this, but is a lot of those expenses, like driving around and all that, I associate more with active participation in real estate activities versus passive. And, the safest thing passive is to deduct expenses directly attributable to that project.
Yeah. This is kind of frustrating because I feel like it should be more cut and dry. Like you shouldn't, I feel like maybe there's something we're missing. Like if we talk to, I don't know, because it's like, I mean, he talks about being aggressive, but other types of stuff, if you deduct depreciation, you don't have to pay anything, and there's no aggressive, not aggressive. It's cut and dry, and this doesn't, something that is just like, I feel like we're missing something. I mean, I'm sure maybe we're not, but
he mentioned in the book too how you're saying that you might go to a certain attorney, a certain CPA, and because they don't want to trigger an audit, they don't give you all of the aggressive deductions like say he would. because he has more experience with it. So it's like a preference of your comfort level, I think.
Yeah, yes. This tax reform was rushed through Congress so much. I doubt that there was any single individual that even knew what they were signing. And I understood that even after it was signed, the IRS still didn't really fully digest and understand all the rules.
Well, I'm not even talking about the most recent tax thing. I'm just talking about, I mean, some of the stuff refers to, stuff prior, I think, and maybe like deducting meals and stuff. It's just, it can't be, I mean, I guess if you do an audit, you have to kind of don't you almost have to somewhat prove to the IRS as opposed to they have to prove you're not? So isn't it kind of harder? Like, if you go on one of these meals, then maybe that's why the greedy part, because then you could just, if they say it's one meal a month, I guess they're not going to care since you're, I don't know, just kind of, Lane, you probably get it being an engineer somewhat, but I'm more used to, binary cut and dry
Well,
stuff.
it's not binary, right? And this is what scares a lot of people off from this stuff. The average person doesn't want to even play with this stuff. But I mean, I get what you're saying. I mean, like I think like Troy and I would agree to disagree, right? Like he'll deduct it, I won't. But it's not like it's at the end of the day it's that big of a deal.
Right.
I mean, if he runs around in his car, it's like he'll take an extra few $100s of deduction. Like I don't care. Like for me, I don't really care.
Yeah.
And there's the other things I'll be more aggressive at.
Yeah, the gray area may be but like you say, the stuff that directly, deals with the property, yeah, you can try to be more aggressive. But again, it's just the comfort level and depending on, like he was saying, the CPA you use that will, help you say, well, yes, you can do this, which might make you more comfortable. He say, oh, no, don't do it. So
yeah, like
level.
I think maybe you need to interview an auditor for your next podcast sometime.
Well, I mean,
that'd be an interesting exercise.
I mean, in fact, those guys should be asking you guys what the heck that you're doing.
Yeah, because some
time of a lifetime, turning point for them. So it's kind of moving on the agenda here. Bullet point number 6. They discussed briefly on the 1031 exchange. I personally don't like the 1031 at all because you kind of kick this can down the road, and then sooner or later, I mean, I just talked with 2 guys this week that had $2 million of capital gains, and even with the home exemption, I think it's section 179, you're gonna have to pay that back, and you're gonna be going into bigger and bigger deals. You're just a captive seller at that point and buyer. That's an option. I'm saying it's a good one personally, but
it definitely has its pros and cons.
Yeah, I think all too often with the 1031 and I like the solar 401k, but the self-directed IRA I'm not a fan of. I think all too often they say that that's the silver bullet for everything, and because that's how they make their money.
Self-directed, no, the solo 401k is a silver bullet.
Yeah, I like that. Yeah, but the self-directed IRA, not a fan of that one.
Yeah, I have my wife and I each have self-directed Roth IRAs, but we also have solo 401ks with both Roth and traditional components. The only reason we have self-directed Roth IRAs is because when we created solo 401k, the IRS will not allow you to roll over a IRA or Roth IRA into a solo 401k. So it was kind of orphan money that we just couldn't do it.
I don't really want to get into that topic because it'll get me really fired up and I'll probably get the rest of the hour.
Sorry.
So let's
do it.
Let's move on to bullet point 6. That'll change to 8, which is give income to your kids. I don't think.
Can we go back up to 7 real quick?
Yeah, go ahead.
I just wanted to make a comment. If I was editing the book, I wouldn't have called passive income another type of income because it's more of a categorization of one or more of the above. As far as it's not like its own separate thing. I think it still falls under.
I think it is, right? On the tax form, it is its own separate thing.
It is, yes.
Is it? But like he's making it sound like it's separate. For example, passive income, that would wouldn't that be investment income? Because you'd have a K1 for stuff like in the stock, like you'd have a K1 for MLPs and maybe some REITs in the stock market. So I kind of took that as like he didn't. I kind of took that as it kind of overarched one or more of those above. Maybe I'm wrong.
Passive income, I think of as income that's derived during the life of an investment, whereas the investment, at least the capital gains, that's more, at sale. And there can be different tax rates for those.
Yeah, but is it true to say if you're a real estate professional, those two get blended together, that wall goes away between them?
That's right. That's why I have a CPA that takes care of all that. I am a real estate professional, and
the reason I say that is because if you look at investment income, he talks about doing 1031s, and your house for a 1031, if you're just doing it like, my understanding, I could correct me if I'm wrong, but my understanding is that my rental property that I have, since I'm using property management company, that would pretty much be a passive as far as income. So like, I think I could probably, like, for example, if I had another passive rental property, I could do some kind of bonus depreciation on that I owned. I could use that to offset income from, say, passive activity in multifamily syndication. So that passive to me was a categorization that was more specific.
Again, I would look at this, Reed, active and passive material participation discussion here.
Okay.
I don't really quite understand it yet either.
No, I was just looking at it from an editing standpoint from the book. It seemed, and maybe I'm wrong, maybe there's something I'm missing. It just seemed like he just kind of put it like because I understand A, B, C, and D, how they're kind of different as far as they're kind of like core different incomes, but then passive was like another concept, I think, related to one or more of the above. So it didn't seem to work from a. That was all I was trying to say. It's not that big of a deal, though. We don't need to discuss it. I was just not much more than what we are, but that's kind of what I saw.
Okay, so we'll kind of go through the last strategies that kind of going rapid fire. Give income to kids. I'll say the cons there is that they'll run away with it. But this number 8, it's not that big of a deal. I mean, you're just trying to shelter a very small amount. I mean, I guess anything helps, but that's my 2 cents on that.
Yeah, you put it on your parents' income, and they might go, I don't need my tax rate going up to help you. So that was funny too when he was saying, yeah, just put everything in your parents' name and stuff. I was like,
yeah, but that one, if your parents
they're cool with it.
they stop working, right? That can be a golden idea. The problem that I put in here in capital letters is, well, it's not a note I wrote. If you got siblings and now your parents die and you were gifting them money because you had this side deal, well then, and you don't get along with your siblings, now that can be a hairy situation.
Yeah, you're talking about trying to give money to your dying parents so you get it as an inherited IRA.
Yeah, I even hear about like people our age giving our parent, making a Roth IRA for our parents, hiring them in our business so they can have a Roth IRA, and then that gets inherited by us. And it's ours, and well, we gave them the money essentially.
I guess it works good if you can be named as a sole beneficiary on that account.
Right.
Or like he was saying, he did put it in a trust, and then you're the custodian of the trust. So that's another way to make it where it comes back to you as well.
Right.
So that's my gray area. It's like,
I had a buddy who their parents had a rental property, like in cash or pretty good amount of equity in there, and they were really cool, and they gave the kids title to it right before they died, which is the completely wrong thing you want to do.
Yeah, IRA is a trust account by definition too.
Right. Anybody transitioning their parents into care home and trying to do that end of life stuff, or have a friend who's doing it and wants to kind of talk about what lessons learned with that, or? No, looks like we're all going drinking later tonight. Then we don't have to worry about that kind of stuff. All right, but I'm not doing that. But I hear that's a mess.
Yeah, it sounds fun. I don't look forward to it.
Yeah.
Number 9 here. This is one I work with a lot of coaching clients. They've got like a big chunk in their money in their 401k. You know, they'll read Rich Dad Poor Dad a year ago or earlier this year and be like, oh my God, I got to change everything I was doing. But I got 400 grand, 300 grand in my 401k. And then they want to use that to invest. And they have to leak it out as income. They have to withdraw it slowly. Again, a lot of things you can do. So it's just, I think the point number 9 is just to be mindful of not blowing up your AGI by taking your 401k out all in 1 year, and then also being strategic when you postponing deductions into a low income year.
One thing I kind of had, maybe it's too beyond the scope, but question number 9, I'm kind of thinking of taking out of the 401k, but I think if I'm right, if I tell them I'm going to do a rollover, they'll give me the full amount. But if I say I want a distribution, I think they won't give me the full amount. They'll take out some percentage of the income plus a 10% penalty. So I think if you take it out, you want to just tell them you're going to roll it over and then just pay the taxes later if you don't roll it over. Pay in your next tax. Does that sound right? The best thing to do? Because I see some people, they'll do a chart and they'll already take out, because then you can just pay, like if you take it out, like it's 2019 now, so I can take it out and then pay the taxes on the, April of 15th of 2020, or does it not work that way?
I think either way, the come tax time, you got to pay the taxes and the penalties.
Well, what I'm saying is, like, if you don't do it the right way, maybe the IRA company will withhold it though, instead of you getting it immediately and then just paying the tax later, because then you can put it into a bigger deal and then just you can start getting some of the cash flow and then you use that to pay the taxes later. So then, I mean, you still got to pay the taxes, but that's kind of what I was getting at.
Yeah. I mean, don't come looking for me for a loan.
Blade's like,
but I think just make sure that you really don't roll it over, right? Because once you want to roll it over.
Here's the deal. Every time I've done a rollover, it's never touched my hands. And I just looked it up because I was curious about it. So it sounds like there is a 60-day rollover where you can actually have it paid to you, but you gotta complete the rollover within 60 days. And they're actually going to make a withholding for taxes if you do that. But then you have to make up that difference to do the full rollover. So let's just say that they withhold $50,000 for taxes on a big rollover. You're going to have to come up with $50,000 for your own funds to say it's $250,000 to make the full $250K. And if you don't, I would assume that $50K would then be deemed a distribution. That would be taxable.
Yeah, because I've done a rollover to a self-directed, and they just do it directly. And even if they wanted to send me a check for me to do it, I think they would have still sent me the full check as long as I told them it was a rollover. I think.
Yeah, I'd prefer just to have it go directly to the new custodian. I think that's a lot safer.
Yeah, no, I know. I'm just referring to trying to get the full money as opposed to getting it withheld. So then, like, let's say I wanted to take out $50,000 for my 401k. If I tell them I'm taking out $50,000, they're going to take out income tax plus 10%. But if I guess I was wondering if it was legal to say, hey, it's going to be a rollover. After 60 days, yeah, they're going to report it to the IRS, but I don't know if there's actually any penalty. I wouldn't have to pay those taxes immediately. I just pay those in the next tax return. And yeah, you maybe have to take more.
So, yeah.
You'd have to take more from the next year for your 401k to pay those taxes. I think you're kind of still ahead.
It might not be like a government law where you have to withhold, but it might be like a Vanguard or Fidelity policy.
Yeah.
That they have to withhold it.
Yeah, because I know sometimes they'll ask you, hey, do you want to have the money pulled aside or you don't? So, but you still have to pay it in the end. But
think the best thing is if you can you take out a loan against your 401k? That's what I would do.
Yeah, most 401ks you can only take out a loan. Well, correct me if I'm wrong. I think most 401ks you can only take out a loan for those 401ks in which you're currently still an employee. I think.
Oh,
That's correct.
Okay. And I don't have any of those anyway, so.
So do you have a 401k from a prior employer?
Yeah, so I don't think I could take out a loan for any of those.
Do you have any self-employment income?
Not besides passive multifamily syndications.
I'll tell you, tell yourself you're starting an eBay business. Go put a few things on eBay. You're self-employed. Create a solo 401k. Roll over your prior employer's 401k into a solo 401k.
Oh yeah, no, I need to do that for some of that stuff. But I'm just talking about trying to get it out of the IRA structure entirely, so you can.
Yeah, because once you get it in a solo 401k, then you can lend yourself the lesser of $50,000 or 50% of your account balance for any reason and pay it back over 5 years.
Oh.
Solo 401ks are really powerful investment vehicles. It's totally transformed my finances.
Yeah, I'm gonna have to look into that more because I've got self-directed IRA for a small amount of stuff, and it's pretty horrible. I mean, I haven't actually dealt with the taxes yet, but I know I'll have to pay taxes from it.
So, but getting back on track here, number 10 here, bringing your parents as business partners and making them partners in your corporation or LLC and flow the income onto their little tax side. I thought that was a pretty strong one. I wouldn't do that personally, but I think for a lot of people that are on the same page, that might be a good one. And then on page 90, they talk about that 20% pass through, where I think the press got a hold of this one and they really ran with it. I don't think it's that huge of a deal. That's on page 90, 91. And then deductions versus credits. Again, so we don't lose anybody behind. Deductions, they lower your HEI. Credits are, if you owe the IRS $1 and then you get a $1 credit, you don't owe them anything. It's like a 1-for-1 thing. So in a way, like if you're in a 25% tax bracket, $4 of deductions is equal to $1 credit.
I bought a Tesla a few months ago. I'm looking forward to that $7,500 tax credit.
Yeah, why did they give you like a rebate or something like that? What was that all about?
Well, no, that's an IRS government program. They can't. I mean, you talk about the rebate that I posted about on Facebook?
Yeah.
Yeah, so that was a situation where they included the performance package as standard equipment shortly after I bought it. And so they offered to either said if we were willing to give up our free supercharging for life, which the new ones didn't have, then they would give me $5,000 back.
Oh.
And I said, there's no way I'm going to use $5,000 for free supercharging in my lifetime on that car. So I took the money and ran. It was a nice little gift, though.
One of the things, and I might have heard it in a Tom Wheelwright podcast, but one of the things some people might need to be careful with too is you can do stuff. I think maybe if you do the home office deduction versus if you say do some kind of, if you're like an active real estate investor and able to offset with depreciation. I know on some podcasts I've heard too, you want to, depending upon if you're trying to get credit elsewhere, you want to, even though it might help you on your taxes one way, you might not want to do it because it can lower I guess maybe it's the AGI, and then it's harder to get loans and stuff because that's just what they see. So for whatever that's worth, that was in my head.
Yeah, it's you lower your AGI, you make yourself look like a turnip on paper, but then when you want to go get a loan, you don't make any money. So
I'm a poor broke bum if you look at my IRS.
But I mean, in the beginning, I think when you're picking up Fannie Mae, Freddie Mac, turnkey houses, or doing your own stuff, it's a big deal. You need to show good income, AGIs. But as you transition to more of a passive syndication type investor, like me personally, now I'm having a lot of fun because I get to play around with a lot of credit cards and all that travel hacking stuff once again. I don't care. I could care less about my credit. In fact, I'm actually going to go play it around with like trade lines and stuff like that. That'll be kind of the next project I play around with. So stay tuned for that. But I mean, that's the paradigm, right? You can't be, you got to have the big picture here. You can't go crazy with this stuff.
Yeah, I haven't applied for a mortgage since being self-employed, but everything else, you know, has not been a problem.
Yeah, it's a good point, Larry. Don't be a bonehead. The last one here, item 13 on page 98, it kind of glazed over types of credits with family, education, charity, investment. I personally don't use anything. Does anybody in the group have examples of any of these that they've taken? Want to share?
I get a tax credit for my kid. I'd be interested to see what he says about charity. I don't have the book, but I believe that charity is typical. Charitable contributions are deductions, not credits.
Yeah. I think they're on your Schedule D, is it? D.
Yeah, and I think investment credits, they might be like, you know, oil and gas, some oil and gas deals, you'll get the IDCs. But I think you're right here. They are credit. They're not credits, they're deductions, but I think a lot of like the education ones, like Troy was mentioning earlier, that counts as a credit.
Right.
Or
then,
like your car, right, Chris? The Tesla thing, that was a credit.
Right.
Yeah, this was one where they kind of, you know, he kind of drops it in there like it's the best thing ever, and then doesn't really give you concrete examples. So I did a few quick searches, and you know, you think there'd be there are some lists, but they're the very basic ones. And I think, you know, the implication here is there's other things out there that we don't know about. So
yeah,
there is a new one, and I forget what it's called, but it relates to investing in, I guess, you know, less economically developed areas or more, you know, less desirable areas of some kind of community investment tax credit.
Oh, the
opportunity zone tax credit. That's it.
Yeah, I'll put that URL in there too.
Yeah, I've got some friends that are doing that right now, and I'm looking into it myself.
Okay, anything else?
When he was talking about the charitable credit, I didn't really understand that. You guys are talking about deductions. I know about the deductions, but you said you can get a credit in addition to the deduction. So he was definitely having a differentiation between the two. So that's something I need more information on. But it's more than just the deduction. I guess it depends on the charity. So he's talking about, you know, feeding like for homeless or impoverished people or something like that, and as well as other types of charities. But that I don't really know anything else about that.
I'm doing a quick Google search, and it says that some states offer a tax credit. So I think one of them I saw was Arizona. Right, let's see. New Jersey, New York, Connecticut. Anyway, you can look them up. So if you pay state income taxes.
Yeah, I was kind of hoping somebody played around this a little bit, because I don't really like to go off the beaten path of this kind of stuff. But it looks like not. I guess the takeaway is just have kids, right, Chris? All right, anything else for the cause? If you guys like this, I'm gonna have the new program come out for the group coaching format, which is kind of like this format, bi-weekly calls. So if you guys know anybody or interested, let me know. What's in the pipeline? I'm still trying to fill up this 101 unit Class C in Mississippi, and you guys always like to know where I'm going. So I'll be speaking at this multifamily investor summit, January 17th to 19th. That's online. February 16th, I'll be speaking at this Hawaii investing conference. There's a code for all these things. March 1st, 2nd, I'll be in Scottsdale, Titans of Multifamily Real Estate. March 14th, be in Los Angeles for Tony Robbins. And if you guys are an investor, come and hang out with me in Hawaii and get a deduction, as we said. So you guys' homework for next time is to read up to page 150. I'm guessing that's about chapter 15 or so, 15 or 16. And we'll just keep chugging right through this thing.
Hey, Lane, I'll be in Hawaii about the second week of July, so.
All right. I think I might be gone, but let's connect here in a little bit.
Okay.
And then you can sandwich your meeting here. We'll do that for you. But you gotta buy me some food.
Sounds like a deal.
All right. All right, guys. We'll see you guys next time.
All right, see y'all.
Yeah.
Okay, thanks.
That's it.
Thank you.